Good afternoon and welcome to a special time and special episode of Legal Tech Live. I'm your host, Nick Rishwain, and I'm here with my guest co-host, Ellie Mattern. And our guest today is Phil Nadel. And I'm saying that correctly now, Phil? Did I get that
Close
one?
enough. Close enough.
Nadel? Is it
Yep,
Nadel?
that's it.
Phil Nadel. Phil is... This is great. I'm sorry, guys. I'm a little excited for this interview because I'm a fan of Phil's analysis on another podcast that I'm going to tell you about right now. So Phil Nadel is a well-respected serial entrepreneur, angel investor, published author, and frequent speaker at industry conferences and events. He has started and sold several companies and has invested in more than 100 startups with several exits. Phil co-founded Forefront Venture Partners, formerly Barbara Corcoran Venture Partners in 2014 and has been its managing director ever since. Phil is also one of the investors on Gimlet Media's The Pitch podcast, one of my favorite podcasts at this time. And as I've already explained, just a fan of Phil's analysis. And I reached out, asked him to come on and share some of that analysis and experience with the legal tech community. Phil, thank you for doing this. And And we're glad that both of you are safe from Hurricane Dorian. And Ellie has this great startup, great beginning question for us that she's going to ask while I jump us over to Facebook Live. Ellie, go ahead and jump on in.
Cool. So, Phil, when I was reading your bio, it mentioned that you had been a part of a lot of startups prior to your work now. And so I was just curious what kinds of startups you were a part of and in what capacity, and if you could tell me a little bit more about your background.
Oh, sure. So when I went to business school, went to the Wharton School of Business, and afterwards started a company in the financial services business. And we were doing mergers and acquisitions for a specific type of public company at that time called Blind Pools. And so I did that for a while and started work with a publishing company. I started a publishing company that at the time was just doing offline publishing, because this was a lot of years ago, before the internet. And that grew quite a bit. We had an exit there. And then I got into the financial services business, which is really where my heart is and has always been. So I started an asset-based lending company back in 1990 called Florida Asset Financing Corp, which is still operational, still doing well. I started a commercial factoring company called Cambridge Factors, which we sold many years ago to Reservoir Capital. That we had a nice exit, and started a lot of other financial services companies. So that's been an area that I've been involved with. But then I've done some other things as well. I had an online rewards and incentive company called Gulfstream Internet, where we had several different websites there. So I really tried to do a variety of different things. Again, my heart has always been in finance, but I think that the breadth of experience that I've had in different businesses, some are B2B, some are B2C, has really helped me in terms of being a venture capital investor.
Cool.
Yes, very good. And this is really good for our community. We got a lot of insights or a lot of questions from the community who seem to be desperate for cash. The legal tech community got one really big piece of news this week with a $250 million investment into Clio, and that was a big one, and that's the biggest this year and one of the biggest ones overall in legal tech. So yeah, those of us in the startup world in legal tech are just really desperate for some information. So Phil, we got some questions from those in the legal tech community on Facebook, and one of the ones that came from Jason Velez of One Law was, it was just simply, where are the legal tech investors? and I don't know that you can answer it that well, or where are the investors that?
Well, I think that's an interesting question, because it's not like venture capital investors are standing around with a sign that says, I'm a legal tech investor. But what it comes down to, from my perspective, is any company, whether it's a legal tech company or otherwise, that is solving a real problem for their customers, right? A real pain point, and is growing quickly and has reasonable margins and a good size addressable market, ticks off all those check boxes that we look for in any company, they will find investors for their legal tech company if they check those. So it's not like don't think of it as being different than any other type of startup just because it does happen to be in the legal tech space.
Okay.
I don't think there's any kind of pejorative against legal tech investing in generally speaking in the VC community. So they're out there, but they're not labeled so much as a legal tech investor as they're just, a VC fund. So you need to knock on a lot of doors like every other company, present your case for why you're solving a real problem for your customers, how you're doing it efficiently, how you're going to grow, and then you'll find the money from general investors. Does that make sense?
It does. It does. Makes good sense.
I got another question kind of under that subheading.
Yeah.
So as we mentioned before we went online, I'm in Orlando and my company's in Orlando. And it has been really, really interesting to me, the dichotomy, and I'd just love for you to weigh in. So there's a lot of hometown pride around the startups that are built in Orlando and probably everywhere else in the country.
Right.
And so everyone I meet in Orlando says, keep your company in Orlando, grow it here. And people I meet from outside of Orlando say, you got to be in California. That's the only place the investors are. And so when I heard that you were in South Florida, I was surprised. I assumed you were going to be in California. Do you have any opinion or thoughts on whether people should, go to California, my friend, seek gold, or try to grow in their hometowns?
Yeah, that's a really good question. And I think it depends on this. It depends on what your needs are as a company. So one of the benefits to being in the Valley is access to talent. And that's probably, and access to capital. But both of those things are becoming less and less important. So the access to talent, a lot of talent these days is remote, works remotely. And so more of that is going on than ever before. And a lot of companies are tapping into remote sources and foreign sources of talent, especially on the development side. It's different in the sales role, but that can be done remotely too, certainly. But on the development side, much of that is being outsourced overseas and being done remotely. And the Valley traditionally, that's where you get a lot of the tech talent, and of course that's still true. But it's not. You don't have to go there. And for the capital side, there's a new sort of interest by a lot of different funds and investors in specifically investing outside of the traditional VC hotspots like the Valley and New York City. And so, firms like Rise of the Rest and some of the others that are focused on a region or even on what they call flyover cities or flyover areas, that's gaining popularity. And also with the amount of money that's come into the VC space over the last several years, there's just this need to have a portfolio built of companies that are really everywhere. If you're still a fund that's focused just on investing in companies in Silicon Valley, it really becomes too limited, but B, the valuations that you pay are so much higher. So we find we're very much open to investing in companies everywhere, and the valuations that we get are much better when we invest outside of Silicon Valley. So this is sort of a long rambling answer to your question, but
no, it's a great answer.
I don't
think there's one answer.
Yeah. I mean, it depends. So there are certain types of companies that will benefit tremendously from being in the environment of Silicon Valley. Super high tech companies specifically, where that kind of talent, that kind of expertise can really only be found in the Valley. But the problem is you're going to spend so much more. The cost of living is so much higher there. The cost of talent is so much higher there. So it really drives your OpEx up quite a bit. And I think that's, you have to weigh that when considering a move. And so I always root for companies and have no problem investing in companies that sort of stay local, but they do have challenges in hiring. And I always encourage them to seek, remote solutions to that where they can.
Yeah, it's a great answer, because we just seen it in LegalTech even this year with some of the seven figures, $2 and $3 and $4 million investments in startups, and then I see that San Francisco Bay Area, the pictures of the new office, and I'm thinking, man, this is going to be an incredible burn rate of all that money you just got, on the office alone.
Hey, I respect entrepreneurs who are scrappy and lean, and much more than I do those who have fancy offices and are spending. When I see fancy offices, all I think is money going out the window. I want to see scrappy and lean. That's, bootstrap. That's what I'd prefer to see.
That's good. That's good. Listen up, folks. For those of you watching, we've got Morris Lilienthal, AJ Richmond, Joanne Kroll, and Aaron Levine, and at least one of those is a LegalTech startup founder. So, Aaron, I know you're out there. If you have questions, our guest is Phil Nadel of Forefront Venture Partners. So make sure to ask your questions. Phil, our next question, and I believe this was also from Jason DeLez. He had a couple of questions, and he said, are there any suggestions or directions on finding what he quotes patient capital for legal tech development? So that sounds more like while they're in the development phase, almost pre-launch. Am I wrong on that? Patient capital? Is that a term you're familiar with?
I understand the connotation of what that means. But again, I think it's not a matter of. It's a matter of finding the right fit for your investors, right? And it's not, again, I don't think some investors are patient and some are impatient, or by sort of their by the definition of what their fund is. Mm-hmm. I think that certain people are just understand the space more, understand that pre-revenue companies that are in the development phase are going to take a while. And if they don't understand that, and you're not aligned on thinking in terms of the sort of development timeline and when you start generating revenue, then it's not a good fit. In other words, I really advise against taking any money you can raise because you're desperate for money. I think it's really important to have good alignment with your investors. And part of that is that they understand your developmental timeline. They understand the projections in terms of when you're developing or generating revenue. So I think it's there are patient and impatient investors in every fund, in every company. So it's a matter of aligning with the people who understand your vision and understand the necessary timeline. Now, I will say that investors will try to help in terms of speeding the timeline up, which is good for everyone, but their help should be, truly helpful and not obstructionist and not pushing you to the point where, you're taking shortcuts or trying to generate revenue before you're ready. So the product has got to be good. It's got to be really good before you launch. But I think the attitude a lot of VCs have, which I understand, is ready, fire, aim kind of thing. Which is, look, if you have an MVP of the product, get it out there. Let's get some customers actually using it, get feedback, and then iterate and then make it better. You don't have to make the product 100% perfect. What's the expression? Perfect is the enemy of good.
Good, yeah.
Yeah. So I mean, perfect will kill you. So I think it's got to be a meeting of the minds between you and the investors. The investors have to be patient enough, but you have to also understand their agenda in wanting to get you to post-revenue stage. And so an agreement on, yes, we're going to launch when we have an MVP. We're not going to get to perfect. We're going to launch it as quickly as sort of feasible. I think that's the key thing.
Excellent. Excellent. We have a question from Fernie Gomez, who is out of Latin America, and has this question. We have a very, very international group these days. Have you thought about investing in legal tech companies? Or this can be even more general, because I know that you're not specific into legal tech, but thought about companies in Latin America, or as Forefront, are they more focused on US-based companies?
We're mostly focused on US, but we have invested in companies in Canada, in Israel, in the UK, but 90-something% of our portfolio is in the US. And mostly the reason we don't invest in South America and Latin America is due to SEC regulations. So, as you may know, Forefront is an AngelList syndicate. So we're one of the largest syndicates on the AngelList platform, and AngelList has restrictions about where we can invest and what companies they'll allow us to syndicate based on where they're located. And their restrictions are just based on SEC regulations. So a lot of it is that. And I have no problem personally, investing globally, but it's just, we try to live within the restrictions that we have from AngelList. But there's great, there are great companies everywhere. And we have invested in a few companies that do business primarily in Latin America, but they are US-based companies. And that's the sort of end around that a lot of these Latin American companies take, is they'll incorporate in the US and maybe have a headquarters here or just an office here, but their operations are primarily in South America or Central America.
Oh, good.
So
yeah, go ahead, Ellie.
So if a company was interested in seeking investment from your firm, what would be the first step? I know I'm skipping ahead and Nick, your question suggestions, but do you mostly deal with people that you know? Is it cold call where people submit things to you guys, or what's your process?
Yeah, thanks for asking. A lot of VCs don't like cold outreach, cold emails, or cold calls, and they only take referrals from people they know. But we encourage everyone to get in touch. I really prefer that they look at our criteria on our website first. That'll save them some time and save us some time. But if they feel like they're a fit based on the criteria on our website, absolutely, just shoot me an email or contact me on LinkedIn, and we'll get back in touch. We're very responsive. Most of the deals we do invest in come from referrals from people we know, but we've certainly done plenty from cold outreach, so we're definitely open to it.
Okay. And I've gone ahead and posted in the Facebook group to check your criteria on the website as well before they reach out. So that's
always good research before people cold email anyway. You should probably look the people up before you email them. Yeah,
the best ones we get. I love when we get emails where they've listed all our criteria in their email and specifically addressed how their company addresses each one, which is, I'm not suggesting you have to do that. I'm just saying that's always very good, a very good sign for us.
Well, it shows a level of preparation too, doesn't it?
Exactly.
Then it attempts to make the persuasive argument for you as to why you should be interested in their organization or company.
Yep, that's exactly right. So we always like that.
Excellent. Keep those questions coming in the live group, folks. But we are going to go on to another one from the group that this one, I believe, came from Sujesh Krishnan of Konami. He's a legal tech, blockchain legal tech startup. And his question was, best practices for getting a syndicate like Forefront Venture Partners to consider a startup investment. Maybe some of this we just covered, but he said is the usual process, referred by an acquaintance. We did actually do this. The referrals and cold outreach, but he had a second part of this question here is there a path for early stage pre-revenue companies, or are you required to have more established, have some revenue and some traction?
I don't know if that question is a general question, or is he asking what our criteria are, but for us, we only invest in post-revenue companies. We don't need to see a lot of revenue, but we need to see some revenue. But there are certainly lots of investors, including syndicate investors, who invest in pre-revenue companies. It's just not our thing. So, yeah.
Yeah, that's great. Yeah, that is very helpful. And then he did have a second follow-up. So he said, regarding valuations, and this is a great question because it's something that a lot of us, don't know. Regarding valuations for early stage companies, are there best practices for an entrepreneur to determine valuations?
Valuations are an art, not a science. As much as we sometimes try to make it into a science. So I think the best idea, and I've gone through this with some companies recently on the Pitch podcast, who have come in with either valuations that were either way too high or in one instance way too low. The best approach is to really speak with people in your network who are knowledgeable and have experience in raising capital. And especially speak to people who've written a check into your company, if you have some, because it's easy for people who haven't written a check to give you advice, but someone who's invested, that's more valuable. So the short answer is the valuation is whatever the market will bear, right? And so that's what you have to try to figure out, and a lot of that is trial and error. You talk to VCs and you get a sense of where they think, if they're interested, of where they think the valuation. And I think it's best to I prefer when companies are completely candid. When founders are just candid with us and say, look, we haven't priced it yet. We're looking to raise whatever, $2 million, whatever the amount is. And we're talking to investors, but we haven't priced it yet. We're getting there. We're getting to that. So until you really have a commitment or have a term sheet from an investor, I think it's better to keep that discussion fluid with investors and just be candid and say, it's open, and what do you suggest, or where do you see it, and solicit their feedback. And I think if you do that enough times and you get honest feedback, you can sort of triangulate to an approximate evaluation that'll work. If you get enough feedback. So I think it's important to get feedback from your advisors and investors, but also from the VC world.
Excellent. Ellie, did you have a follow-up?
No, I just was taking notes. Valuation is something that has been really, really difficult of a concept, because I feel like your idea about triangulating from actual numbers is a really solid piece of advice, because most people, anytime I ask someone about how to figure out valuation, I get a different answer.
Yeah.
And so since it is so subjective, in terms of that equation, at least getting a number would be useful in terms of helping. I think that'll be a really actionable piece of advice for starters.
And if I could just follow up on that and say, I don't think that founders, especially on their first round of institutional funding, should get too hung up on the number. I mean, it's important to get the capital. And if the valuation is within sort of an acceptable range to you as the founder, then take the capital. If it's the investor's a good fit, take the capital and worry more about the valuation in your second and third round. You've got to build the company. That's the primary goal. Build the company, grow the company, have the fuel that you need to feed that fire and grow it. And I've seen first-time companies raising money for the first time get too hung up on the valuations. They lose sight of the big picture, and they end up not raising. because over, a small difference, relatively speaking, in valuation. If it's in an acceptable range to you and you can live with the dilution, I say get that first investment in and then go from there.
And I'm going to add to this here, Phil, from listening to you on the Pitch Show. I'm going to recommend that folks go over and download that or subscribe to the Pitch Show and listen to how Phil, what really caught my attention in the show and what made me reach out to Phil was how he analyzed what people were asking for. And it really will give you some really great insights into, because I've heard you say, I think this is fair. I've also heard you say, why are you asking for such a low amount? And the opposite of that, I don't like this valuation. It's way too high. So there's a variety of different episodes on that show where you can hear the financial analysis, the valuation analysis that Phil provides. So I do encourage you to take a look at that.
And it's funny because different, investors, even on the pitch, but just in general, will react to a valuation in a different way because it's based on their experience of seeing similar companies and what their valuations are. So that's what informs our opinions about valuation, whether it's realistic or reasonable or not. So when a company comes in with a valuation that we determine is too high, what I mean by that is I'm not making a sort of a value judgment about the company and saying you're not worth it. I'm saying that the valuation is higher than other deals we've been seeing that are similarly situated. Other companies that have similar revenue, similar growth rate, similar metrics are raising at lower valuations than you are. Therefore, I'd rather put my money into those deals. That's what, it's always a competition between deals. There's only so much money to go around. And so we have to pick the best deals. And part of the best deals is not just the company with the best product and the best founders, but it's also the ones where we can have a reasonable valuation and have a pretty good chance of making a good return. But on the flip side, because you mentioned this, when a company comes in with a valuation that's too low, it becomes a head scratcher. Then you're like, why? Why are they raising it such an absurdly low number? That means either they haven't gotten good advice from, advisors or investors, or they're desperate for cash, or there's some inherent flaw with the company we're not seeing, or it raises a lot of questions. So finding that Goldilocks zone in the middle is the key.
Excellent. That's really great information. And another thing that I really appreciate about the show is how informative the questions are for the founder who's pitching you. You guys ask, you and your other investors ask a lot of questions, but also provide some really great feedback. So it is supportive of the entrepreneur. How I read it. And I like that. It's not trying to take somebody down. It's really
well. That's right. And one of the ways that we differentiate the show from Shark Tank, which is a show we're compared to often, is that we're very supportive of entrepreneurs, and our format lends itself to providing them with a lot more time to provide information and for us to ask questions, as opposed to Shark Tank, where it's usually 10 to 15 minutes or something like that. Right. So it's we really do. And in fact, the part that you don't see, listeners of the podcast don't see, is the relationship that we develop with the people, the founders who are on the show, and how we support them afterwards, even if we didn't invest. So I consider anyone who's been on the pitch to be part of the pitch family. And even if I pass on it, I'm going to do everything I can to help them make connections, introductions, advice, and I keep in touch with the companies for as long as they want to talk to me. So so that's the supportive kind of attitude that we have.
And I really appreciate that, because that, at a much smaller scale, it's what I like to do with this show. I've stayed in touch with just about every former guest, and if I can make an introduction, I do the same. We have a question. Great. I want to be a proponent for those who visit the show. We have a question from Diego Alcala, who was my guest host last week. And he said, and this is a formation or a corporate governance kind of question, and I've had some experience with this, but he wanted to know B Corps. Any thought about that or on structure? Are you regularly looking at somebody needing to be incorporated before you invest, or what is the structure?
It was a question about B Corps or about incorporation in general?
I think it's,
So it sounds like he was asking about certified B Corp.
Right.
And the reason I was smiling when you asked that question is literally just today, one of our portfolio companies called Grove Collaborative, which is a certified B Corp, announced their Series D1 financing round, which officially made them a unicorn. We invested in the Series A round at a $12 million valuation, and they're now at over $1 billion valuation. They just announced it today. So that's that company's doing great. Shout out to Stu and the team at Grove Collaborative. But they are a certified B Corp. They are an e-commerce company that sells products that are healthy and non-toxic, cleaning products for your home that are completely non-toxic and much healthier. So we're not the type of investor who generally seeks out B corporations, but we have no problem investing in them. We like to invest in them because we like the social mission. But that is not going to tip them in favor. That's not going to sort of be a positive for us beyond anything else. In other words, it's got to make sense from an investment perspective. That's just icing on the cake. If we see that they're going to make a positive social impact, great. But all the other elements have to make sense. With Grove Collaborative, it did. We invested, and it's worked out well. And if we end up investing in a company with a positive social mission, then fantastic. But we're not. There are certainly plenty of investors out there who seek that kind of investment out. They look for companies that are doing good in the world, and their financial returns are secondary. That's not us. Our financial returns, especially because we're investing for our syndicate investors, our financial returns are primary. But we're always very happy when there's a positive social aspect to it as well.
That's excellent. And then I guess it would lead me into, I had added to, Diego said, thank you, by the way, for
Sure.
that
Thank you, Diego. That's a good question.
Yeah, I added to that, is there a sort of business formation that works best for a startup? Do you think that they should start off as incorporated at first to begin with, or any sort of LLC preferred, or any of that? And I realize you're not giving any. We have a bunch of lawyers watching this, so you're not giving legal advice. Just, is there anything that you've seen?
Yeah, I wouldn't profess to give legal advice to a bunch of lawyers. But I will say that from my experience, we have been we are allowed by law to invest in debt rounds for LLCs, but not in equity rounds. So the syndicate is we form an SPV every time we invest in a company, and that SPV can't be a shareholder of an LLC. It can be a debt holder. We can buy notes, but it can't buy equity. So if we end up buying convertible notes in an LLC, we have to have an agreement with them up front where they say that they will convert to a corporation, a C Corp, upon getting an equity round of investing done. So once they have an equity, priced round, an equity round, they have to agree to convert to a C Corp, so that when our notes convert, they'll convert into stock in a C Corp. So the short answer, at least from our perspective, is we invest in equity in C Corps, and we invest in convertible notes in either LLCs or C Corps.
Okay, excellent. That's great. Ellie, do you have one to jump in on? And also, anybody in the group, we've got about eight or 9 minutes left. I don't want to keep Phil all day, but if you have any last minute questions, get those in. We have a couple more from that people have submitted. Ellie, go ahead.
So I have another question. So I have a company, I have a startup, and so all my questions come from like things that we've experienced.
Sure.
And one of the things that has come up time and time again in conversations with investors and or with just other founders around Orlando and around the country is about bootstrapping versus not bootstrapping. And I'd love to hear if you have a particular take as to whether or not companies that are pre-revenue or whether companies that are like ramen revenue, whether there's any added benefit in your eyes for somebody who has bootstrapped up to a certain point, or if you're like, just raise the money if you can raise the money. Because I've really heard people come in both sides of that equation.
Yeah, people have different views on it. As I said earlier, I really respect entrepreneurs who bootstrap and who operate in a lean way. Sometimes that means raising money from family and friends, but staying lean and bootstrap for as long as it sort of makes sense to do that. But if you're successful, you'll get to a point where it no longer makes sense to do that, and you have to go out and raise if you want to grow. And so, as an example, a company we just invested in called Remove out in California, they've been very lean. They've bootstrapped the company all along. They've gotten to a couple $1 million annual run rate, and now they're just raising their first institutional round. The company's been around for like 5 years, and they've grown nicely. And they've spent the time and the limited money that they've raised on sort of really perfecting their process. It's not a legal tech company, but I'm just bringing it up as an example.
No, absolutely.
Perfecting their process, their product, if you will, working on identifying scalable, efficient marketing channels, customer acquisition channels, and running small experiments in marketing and customer acquisition, and trying to get their customer acquisition costs down, trying to get lifetime value up. All of those important KPIs, they've done that on a shoestring budget. And I always have, as an entrepreneur myself, I always have tremendous respect for entrepreneurs who do that. It's much easier to do that kind of thing when you have $10 million in the bank. But when you're scrappy, that's when I think you really that's when you really earn your chops. And so I know not every investor feels this way, and founders who are successful, you'll get to that point where you need to raise money or you can't grow anymore. You just get, you start getting to the point where, geez, we've done sort of all this experimenting that we can possibly do, all the process improvements we can do on a limited budget. We just need to raise. And then it's a matter of finding the right investor. But I think as long as you can bootstrap it and continue to improve and grow, that's great. But when you hit a wall, then you need to raise.
Excellent. That's great information. And that leads us to, I believe this question, and it's sort of general, I think this came from Colin Levy, is kind of, what are your biggest concerns when you're evaluating an investment? Maybe you can, I'm sure that could go out into a really long, there's probably tons of concerns, but maybe a top couple of concerns.
Well, it's like
or red flags.
Yeah. Well, it's like taking our sort of investment criteria and flipping them, right? So, and those are concerns, right? If the company is not solving a real problem, I mean, a lot of times we see that companies will tell me about their product, and I say, well, what problem are you really solving for, and for whom? I love it when a founder has personally experienced the problem, the pain point, and decided to solve it and that there's a large enough addressable market. They can't be the only one feeling that pain point. That's not acceptable, right? To us, it's not. So, certainly red flag number one is they're not solving a real problem or significant enough problem. The addressable market is not large enough. So it's not an interesting investment for us if there's a really small market, so that the total size of the company, total potential, is not very big. That's not good. If they haven't really differentiated themselves from the competition, then that's a concern. And differentiation could come in a number of different ways. We don't need to go into that, but it's got to be differentiated enough that when they go in and make a pitch to a customer, they can make a clear case for why it should be them and not someone else. So that's really important to us as well. And we like to see early signs of product market fit. We like to see, again, early signs that there are some scalable customer acquisition channels that are efficient. And when we don't see those, it's usually a little early for us. So I wouldn't say that's a red flag. It's just a sign that it's too early, maybe.
Maybe not a good fit for your organization at that point.
At that stage, right. But we tend to try to keep in touch with those companies, and as they grow and mature, then it may be a better fit later.
Excellent. That's great. And thank you for that.
Yeah, I can go on and on about red flags, but that gives you an idea.
That gives us some great ideas. And I don't want to keep you all day. This has been fantastic. I'm going to ask Ellie if you have any last question for Phil before we wrap it up here.
So one question I ask frequently is if there are questions we didn't ask you, or if there's advice that you have for a founder that we didn't give you an opportunity to say, either from your days in startups or now as a funder, what would that be? Any parting words from you?
I would say two things, I guess. Be prepared and be candid. So always try, when you're pitching on the phone or in person, always be prepared. Know your numbers. Know your business. I mean, not every investor digs in as much as we do in terms of the numbers, but you should be prepared for that. And you should really know your KPIs. So if you're on the phone with an investor and they say, well, what is your customer acquisition cost? And what is your lifetime value? And what is your retention rate? You should know those numbers. It shouldn't be where you say, let me get back to you, or let me check with my CFO or whatever. But the second piece is to be candid. So if you truly don't know, be honest and say, I'm sorry, I don't have that at my fingertips. I'll get back to you right away with it, and then follow up and get back to them. And just be candid, but try to be as prepared as you can be going in. You're not going to be prepared for every question necessarily. So be honest and be candid. And then I guess the last thing is, always follow up. I can't tell you how many times I'll talk to a founder for an hour on the phone. I'll really like the company. I like the founder. And I'll say, okay, next step for me is I want to look at X, Y, and Z. Please send that to me after our call. And I never hear back, or they won't send it, or they'll follow up 3 weeks or a month later, and they'll say, oh, sorry, I got busy doing this and that. Don't do that. That's a waste of my time. It's a waste of their time. And it's like burning a bridge. I mean, I'm much less likely to want to invest when you come back to me a month later and say, oh, sorry, I dropped the ball. That's just, that speaks volumes to me about that founder. And so I would caution against that.
That is fantastic advice. And I think it brings me to one final question before I ask you to, tell people where to find you and how to get in touch with you. But in an actual pitch, and I've seen some founder, or listened, I should say, to some founders do this exquisitely. But when they start getting hammered by questions from those on the show, and that may not always be the case of how they're pitching. They may just be pitching one investor at a time. But when they start getting hit with those questions, how do they take back? What's your recommendation for taking back control of a conversation?
Yeah.
Focus.
Yeah, that can be tricky because you want to take back control. You want to take charge without seeming too sort of aggressive and without alienating any of the investors. So it's just important to be respectful and say, let me just take one question at a time, and then I'll get to the other ones. So let's start with this one, for example, and I'll address that, and then we'll go to the next one. Sometimes you will get a barrage of questions. The good thing is that that's a positive sign. If you're getting a lot of questions from investors, that means there's a lot of interest. Mm-hmm. That's a good sign. So don't see it as a negative. It's a positive. But it's really important to address all of the questions, but be methodical about it. But you want to just go one by one. Don't get distracted. Finish sort of a train of thought, mm-hmm. then go on to the next thing. And it's okay to say to an investor, would you mind holding that question for a moment while I answer so-and-so's question? let me get to that. Let me finish that, and then I'm happy to answer your question. I mean, I think that that's reasonable, and as an investor, I would never be offended if someone said that to me. It happens.
Right.
So, yeah, I think it's really important. You brought up a good point. It's really important to take charge of that and don't just be responsive to every question that comes. Make sure you answer it fully, thoroughly, and then move on to the next one.
Excellent. That's great. Phil, thanks so much. And Ellie as well. Thank you so much for being on the show today. I really appreciate it. It's great to meet you sort of face to face.
My pleasure. And I appreciate both of you and the good questions from your audience.
Well, thanks so much.
It was wonderful to hear your answers. That was really cool.
Thanks.
Very informative, and we really in the community really will appreciate this and appreciate the replay. Don't disappear right away when we stop recording, Phil. I'll give you a couple of items about the post production, but tell everybody where they can get in touch with you, Phil, if they have questions or if they're interested. We've already said read what his criteria is on the website.
Yeah, and the website is forefrontvp.com. Forefront V as in Victor, P as in Peter, so like Forefront Venture Partners .com. So that's the best place, and there's a contact us link. You can contact us there. Certainly, you can get in touch with me on LinkedIn. I use LinkedIn all the time. On AngelList is a great way. A lot of people contact us directly through AngelList. You can look me up personally, Phil Nadel, or Forefront Venture Partners on AngelList. Twitter, smoke signals, whatever.
And that's at Nadel Phil on Twitter.
Yeah. Because I think my cousin, who has the same name, took at Phil Nadel.
Did he? That's
he's my older cousin, so it's allowed.
He got to it first.
I give him that.
He got to it first. Yeah, the LegalTech community is a very active Twitter community.
Yeah.
Tech,
I don't use Twitter as much as I use like LinkedIn, but I'm there, I'm on it, and I monitor it. So if there are questions or someone reaches out, I'm in touch.
Excellent. So you heard it here. Thank you, Phil. Thank you, Ellie. This has been LegalTech Live, episode 61. The replay will be available next week on the website, LegalTechLIVE.com. And I'd like everybody to know that the podcast is in production. We're uploading all the past episodes and future episodes. That is quite we're catching up. So it will take a month or two for us to get everything up to date, and then podcast dropping every Tuesday as well as the replay video. So,
hey Nick,
yeah,
I just wanted to also say, if someone wants to email me directly, they can feel free to do that too. Phil at forefrontvp.com.
Excellent. That's it, Phil at forefrontvp.com. All of this will be in the show notes on the replay with the links. So thank you, everybody who watched live. We had a pretty good live crew. Diego, Chase Erdl was here, and Fernie Gomez, and Morris Lilienthal, Joanne Kroll, Aaron Levine, AJ Richmond. Thank you all for being here. Thanks again, Phil, and thank you, Ellie. Bye, everybody. Have a great weekend.